Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by Bright Path Notes. Now, here's your host, Justin Bogard.
Welcome back. You are now listening to episode number 19 of season 4 of the Be the Bank podcast. Today I'm going to have my friend Richard Thornton on again, and we're going to be talking about, well, the things that people are talking about and the things that people are not talking about as it pertains to real estate in the current market and kind of direction that we're going in. So stay tuned. This episode is brought to you by Bright Path Notes. Good afternoon, Richard.
Good afternoon. How are you, sir?
I am doing very well. Thank you for asking. And how are you?
Doing great. We finally had some rain out here in California this weekend. So everybody is happy for that. That starts to dampen the fires, and that's a good thing.
I was just going to say that. Is there any fires or smoke now because of all the rain?
There's in some places in the state, there's still some, but there's over 45 fires going right now in the state. So it's not a happy place.
Is it all through the entire state, or is it just certain parts of it?
Primarily mountain regions, Sierra Nevada, up in there.
Okay. Well, California is a pretty big state, so lots of places have fires, right?
That's right.
All right. Well, Richard, thanks for being on again today. As you kind of heard me talk about in the opening package, I hear a lot from real estate agents. I hear a lot from real estate agents that really shouldn't be talking because they don't really know a lot as far as the macroeconomics is concerned as far as real estate and real estate investing. And I hear some people kind of predict things and they're kind of maybe embellishing or maybe going too far extreme on the other side. We've been in such a great seller's market for so long that the slightest tweak, the slightest change in the other direction, people just go bananas, in my opinion. They kind of go bananas, and it's not really, I don't think it's that necessary.
I can't imagine anybody embellishing things to make themselves sound smart.
Right. It's like every time I see a real estate agent list something, I wish I had the descriptions that they do, because everything they sell or do, they have this most beautiful description about the property or the way it looks or how it can work for you. And I always laugh on my breath going, what? Yeah, nobody says anything negative about it, right? Why would they? It doesn't make sense. But it's just funny how if I hear the same real estate agent talk about a property, it's always the same description and, oh, this is so beautiful, so immaculate. And you look at it, you're like, this is a plain Jane house. Like there's a starter home. Like there's nothing, I wouldn't say there's anything beautiful about it. It's just a regular home.
Right.
Now, if I was looking at a $8 million mansion, I might say, yeah, that's a beautiful home.
Mm-hmm.
I guess I've lived in too many starter homes or seen too many starter homes. So anyways, Richard, that's not what we're talking about today. I'm talking about the real estate agent that tells me or tells a group of people of how we are in a market that is a more buyer's market, and we're going into a real estate recession, or we're going into a real estate correction market. And I've actually heard this talk for quite some time, and Richard, nothing hasn't really changed a whole lot. We're still kind of a seller's market right now. We're not really a buyer's market. We see the market cooling in certain areas faster than others. But in general, Richard, we're looking pretty good. The national delinquency rate is 2.89% at the end of July, which is a pretty darn good delinquency rate, if you ask me.
Mm-hmm.
The average has been between 4 to, I don't know, Richard, probably 3 to 5% is a really good national delinquency rate. And we're well below that. We're well below that even before COVID happened. So, Richard, I say this because I feel like there's a lot of misconception out there as far as what's going on in the market. You and I have talked about, yes, we both agree, and we see that there's going to be more non-performing loans coming through the pipeline at some point, right? Because we had 8.2 million forbearances go through, and not all of them made it into a reperforming status, or they resold the loan, or they recasted the loan, or they got a different loan, or they sold the property. Like not all of them did that. Let's just call it half a million. Maybe are in serious delinquency trouble, meaning they're going through loss mitigation, and they may end up going through foreclosure. So that sounds like a lot of loans, but if you spread that over the entire country, that's not that many. I mean, right. At worst, Richard, when we went through the real estate debacle, I guess is what people call it, at least in my mind, that's what they call it. That was about 11% delinquency rate, and you saw about 250,000 foreclosures going through every month. It was like just wheelbarrows of houses, if you will, going to the courthouse steps and just auctioning them off for sale. And right now, Richard, we only see between 15 to 25,000 starts per month.
Right.
This is way different than what it was at our worst. It is way different than what it was during going through COVID, because we had zero, right? We didn't have any. So any number in the positive direction is going to skew a percentage that says it's really bad right now if you just look at percentage numbers. Excuse me. Sorry, I had to cough. But Richard, it's not really that bad, is it?
I don't think so. I'm out here in California, and we don't see it yet. I mean, yes, the market is slowing a tad, but the sky is not falling. Chicken Little is not right. Things are, those things that were overpriced to start with are softening a little bit. But we're still getting people are still getting offers at asking or slightly over, depending on the different house and the desirability. So no, I don't think we're not going to come crashing down here yet. Anyway.
I wouldn't even consider this a buyer's market yet per se. I know I said that a few minutes ago, but I just want to get that point across. It's still a seller's market. Like, we don't have a balanced inventory of, I think, what is it, a 6-month supply of inventory is a healthy balance of inventory in general for real estate. Right. I think we're still leaning towards the less than 30 days for houses to close, which is still an exceptionally fast rate of closing on these homes.
Yeah, because demand is still there. Now rates are going up, and that does affect people's ability to get financing. The number that I heard recently is that for every full point that 30-year mortgage rates increase, there is a 40% decrease in that price bracket's ability. So when they say price bracket, they mean people in the 100 to 200,000, 200 to 300, depending. It dings 40% of that bracket, which is pretty significant. But still, all told, there's tons of demand out there for houses.
Yeah. Even if the mortgage interest rate goes up another 2 or 3%, somebody still has to buy a house, right? It's just right. Bad timing that they get stuck in that window of having a higher interest rate, assuming the interest rate is going to drop back down to more of like a 4 or 3% in the future, which we don't know, because the Fed's going to do what the Fed's going to do to establish inflation and deflation. They're going to try to control it the best they can with that rate. But in all actuality, the interest rate does change things, and you projected those numbers that you just heard. You commented on the numbers that you heard of, and that makes total sense. If 1%, 1 point, you say 1 point raise made a 40% drop in certain classes of buying bands. Mm-hmm. That's pretty interesting. But there's still people buying houses, right? There's still people have to buy houses, so it may eliminate some of the buying pool, and you may not have that much competition. And that may be why we're seeing a cooling of the market, and it's not, days on market aren't as short as they used to be. But yeah, I just kind of wanted to vent a little bit, Richard, today, and just talk about how people's perception of what's going on is kind of skewed in a way that's not really factual, in my opinion.
Yeah, and I know whenever we're talking about anything like this, I'm always hesitant to just believe the broad statement.
Mhm.
I'll give you two quick examples. One is there's very different markets in my town Petaluma, California, just north of San Francisco here, on the west side versus the east side. Well,
Okay.
why is that? Okay. The west side was primarily built anywhere from, I'd say, 1860 to the mid 1920s. So you got a lot of really older homes, not necessarily bigger, but it's a very different style than the east side. The east side wasn't built out until the 1960s through the 90s, and is still being expanded into totally different markets. I mean, they're within a mile of each other, but the west side is much more desirous. People like old Nido Kino, Victorian style homes, which is what this is. So your demand is a lot longer on this side as opposed to that side.
That's interesting. So you have an East Petaluma and a West Petaluma, or still called Petaluma in general. You just have an imaginary line that divides East and
It's
West.
just imagine it's the Highway 101 divides Petaluma, and so that is the line that demarcates east from west. But it's all called Petaluma.
So Highway 101 is the prime meridian for Petaluma.
Yeah, pretty much so. So here's it, right. So here's another prime meridian though. Okay. Right now, my mom passed a while back, and she had lived in a condo. I don't usually act as realtor, but I am in this instance since I have my broker's license. And so she lived in a seniors community. So most of that market, I mean, in this particular market, this community, they have over 11,000 units. Most people buy all cash. So you'd say, well, so what difference does it make if rates go up? Well, it doesn't affect the buyers in that market. There's a very latent effect when rates go up. What happens is that mom or dad want to sell their house that's outside of that area. Their
Okay.
2-bedroom, 3-bedroom house. They can't get quite the price for it they want. Maybe they want to get that over asking, but now they can only get asking. And so they sit on it for 2 or 3 months longer. So that slows down eventually slows down the sales in that retirement community. It doesn't really affect the prices there. It affects the turnover because people are still paying all cash. So that's another good example of sort of a sub-market. So if people are really looking to buy a house, they have to be very specific and ask about their sub-markets.
That's interesting because you're exactly right. People don't actually take it more granular and talk about the submarkets within their community. Even I'm not sure how big Petaluma is as far as population. What is it? 50,000 people?
It's about 60,000. So
60,000.
it's not
Okay.
very big, right?
In your view out there, right? And here in the Midwest, if we were to say there's a city of 50 to 60,000 people, that's a pretty dense populated city,
Right.
For a Midwest city. Unless you're in the main state capital, like Indianapolis, obviously would have more than 50,000. I'm talking about the Greenwoods, the Fishers, the Carmels, the Zionsville. Those are kind of like the cities that are outskirts, just outside of Indianapolis, but around the big loop, which is 465 here in Indiana. Those will be nice size areas. So it's all relative, right? That's the word I was trying to think of. It's all relative to where you're at. And by the way, those of you that want to watch the video version of this podcast, episode number 19, brought to you by Bright Path Notes, you can check out the Bright Path Notes YouTube channel, and that's where you can find the video and just check out what Richard and I are wearing today. He's got a nice little flannel shirt on. Looks like it's a little cool out there with the rain going on in California. And I got this Purdue Boilermaker, just a nice T-shirt with a baseball hat on. So you can come check us out on the Bright Path Notes YouTube channel and also see all the other videos that we have to offer as well. So, Richard, I liked what you kind of digressed into the submarkets. I find that there is a specific neighborhood in downtown. It's more of a historic type of area. It's called Fountain Square. And if you watch the HGTV shows, you'll know that there is a specific show called Good Bones, who is two girls. It's a mother and a daughter. I don't think the mother really is currently active in the flipping business right now, but the mother and daughter would flip houses there in Fountain Square, which is a historic area, kind of historical area in downtown-ish Indianapolis.
Mm-hmm.
And so I was on that street flipping houses in about the 2017 era. And I found that it was a street by street issue.
Right.
We would buy a house for 10, 20, 30, $40,000. We may have to tear it down completely and then rebuild it. And we could see potential in it for selling $300,000, $400,000, $500,000. But then one or two streets over, you may see not very many flips going on, and the values over there, if you flip the house, may only be 150 to 250. But the street that has more flips on it would be valued more, 300,000, 400,000. So it's quite interesting how we had a very specific dynamic within that market that we were in, because I was on the wrong street. I'm always on the wrong street, Richard. That's why I don't flip houses anymore. That's why I suck at it. I don't do that anymore. I lose my shirt on it if I try to do one. But I thought that was pretty interesting. So I like what you said about the submarkets.
So why is it on a street by street basis? That's unusual.
It is such a place that was so hot for flippers to get in there and flip houses. I was talking to my grandmother, and she had one on, I think the street was called State Street. And she remembered that was a house that she lived in the 40s. In the 30s and 40s, and she said she paid like $5,000 for the house.
Right.
And we were laughing, and she was talking about, how much did you have to pay for, this house? I was describing it. I was like, it's completely demolished on the inside. There was no drywall. There's just studs up there. There's trash all over the place. There's no ceiling. It was all torn down, but someone just couldn't finish the work, and so I bought it for, I don't know, I want to say like $12,000 or something, and she was laughing because she had a fully furnished house and everything for brand new house for $5,000, and they're just 70 years ago per se.
So does one street have, if I hear something like that, I start to think, well, maybe one street for whatever reason has larger lots and larger houses or deeper lots, or is there something particular about the different streets, the way they were built out?
Not that I can recall. The lots were pretty similar. They're very shotgun style houses, to where it's just a very long house. The lots are very narrow, but they're very long with the alleyways that run across. So I don't think it's a lot size. I really think it had to do with people kept flipping houses on the same street, and they built them up to where you're making this brand new neighborhood, but it was on a street basis. And so if you only had, if let's say you had 35 houses on the street, both sides, this one street, and you had 5 or 6 houses that were being remodeled on that street, and they were being remodeled to new standards with new millennium style houses. Let's just say the architecture is just more futuristic, and the designs aren't kind of like colonial style. They're just more kind of new era type of house builds. Mm-hmm. And you have another street that's maybe 2 streets away where you have maybe one going on at the same time. And so and there's a lot of eyesores around it. Mm-hmm. So because there's more eyesores around it, my belief was I was about 2 years too early on a street that I did. I had houses on the same street, and that was a big mistake. But it's just funny how the different streets actually were seriously different. As we drove by, the houses were selling for $500,000 2 streets away. No different than what I was building. It was just, they were at the right time. I was at the very wrong time on the street that I was on, because there's nothing on my street that was really getting remodeled. So it was shame on me for not doing homework and seeing that. But yeah, that was quite interesting.
So are flippers making money today?
I think they're making money today, but they are not making money like they did 10 years ago, even 6 years ago. Mm-hmm. I think in the Midwest here, I used to be pretty confident when we were flipping houses back then, about 5-6 years ago, that we could make $15,000 of profit per $100,000 of sales price.
Oh, that's a good indicator.
And then now it's more like maybe I'm not flipping houses today. If I had to venture to guess, it'd probably be like maybe 8,000 to 5,000 per 100,000 to flip a house and make the return on it. I just don't see them getting the blighted properties for such a big discount as they used to versus they are today because of the tighter inventory. So the flipper in our groups here locally in Indianapolis, especially the small time flipper, they're the ones that are really concerned because I think they're getting gobbled up in the wash, and the bigger players are able to kind of get through this as far as volume because they can make their profit in volume as opposed to the smaller flipper that they have to really make their profit on a per deal basis.
Right. So do you see there in your areas of the Midwest also, do you see tech and the ability to work at home affecting housing prices? Because I mean, my gosh, if I were to be working for Microsoft or Google or someplace like that, and I could make $300,000 a year and move to your area and buy a castle for $200,000.
Yeah.
Seems to me that would seriously affect the pricing of your houses there.
It might. I don't know the answer to that question, really. That's a great question, and I just don't know the answer to it. Where I live is pretty further away, removed from Indianapolis, so I don't see the downtown Indianapolis area as much as I used to. My previous co-host, Super E, she would have a better landscape on that as far as if that's really true. It sounds like it would be true. There are a lot of millennials and a lot of young people that like to live the downtown lifestyle. Like, I want to walk everywhere, so they don't really have houses with garages. They may have a street parking, or they may not have a vehicle at all. Maybe they just have a bicycle or something. Or maybe they live in a condo downtown. They have a big parking garage, leave their vehicle in and just walk everywhere. But that's kind of the lifestyle of being in downtown Indianapolis, because the idea is just for you to walk to a lot of places. Not like a New York or Chicago, like a big city, but it's more spread out, I guess, in Indianapolis. It's kind of spread apart instead of squished all together in tight spaces. Right.
So the reason I asked is because there's a town here in the Sierra Nevada. It's not in the foothills. It's actually physically in the Sierra Nevadas. It's about 8,000 feet up in terms of elevation. And it was a small, sleepy mining town at one point. And what several developers in the area decided to do is they actually sponsored some coffee houses and things like that.
Okay.
That intentionally had workspace for digital nomads. And then they built up a live-work office type thing. So they created a nucleus and basically created when you drive up to that town, it says, live here and work in tech. And it's made a huge difference in the real estate market.
That's catchy. I like that. I can see that working.
Yeah.
Definitely see that working. All right, Richard, thanks for being on again today. This is episode number 19, brought to you by Bright Path Notes, and we are out of time, so we're going to just jump off and get right into the transition, and we will see you. Richard, I'll probably have you on again for the next episode, on episode number 20.
I would love it.
All right, don't forget to check out the Bright Path Notes YouTube channel so you can see the video cast of this podcast as well. Until next time, guys, see you.
Bye.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our Bright Path Notes channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by Bright Path Notes. Thanks again for listening.